And then two new crypto strategies. I believe the best time to launch new products is when times are tough and they're out of favor, because that gives the end investor an opportunity to ride the next wave. And, I really believe, if I can just back up and give you a sense, during COVID, as we learned the disaster that COVID would be, the market dropped in 1 month, roughly 30%, depending on the measure. We were down 46%. Our mantra back then was innovation solves problems. COVID's a terrible problem. And then, of course, our Genomic Revolution was our best performing fund, up 180% in 2020. But our flagship, from the low in April of 2020 to the peak in February of 21, went up 360%. And so this idea of innovation solves problems. We have more problems now. We have all the supply chain problems that innovation has helped work out. We have food and energy prices having increased as dramatically as they did. Electric vehicles, genetic engineering allow crops to grow in less fertile areas than Ukraine. So innovation solves problems. And I believe what happened during COVID and after, as investors woke up to the idea that, wait a minute, innovation does solve problems. I believe that was a dry run for what we are going to experience during the next 5 to 10 years as these 5 innovation platforms around which we have centered our research take off. They are ready for prime time.
Cathie Wood and her firm ARK Invest have changed their strategy towards crypto and urge investors that in bear markets and when prices are down, it's the best time to be building and launching products in innovation. In her latest interview by Yahoo Finance, Cathie Wood speaks on why the down cycle has only left her with high conviction in the space as she begins adding to her crypto positions. She also speaks on the FTX blowup and gives her opinion on Sam Bankman-Fried and his role in the crypto meltdown. Make sure to stick around to the end of the video where Cathie explains why markets have never been more irrational and disconnected as they are right now, and why this gives savvy investors that can stomach the volatility a generational investment opportunity. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
I think what we're learning because of FTX is how much more important fully transparent, decentralized networks will be to financial services going forward. FTX, Celsius, 3AC were all closed networks, opaque systems. You couldn't see what was going on. And what happened as they were going down, the people who were on the fully transparent distributed networks were able to get out scot-free. They saw what was going on. There were margin calls for those who were over-leveraged, but the system worked. It didn't skip a beat. Those other companies went out of business. It's a little bit like 0809. The old financial world is very opaque, not transparent. The new world that we're entering, and we do believe DeFi will actually get a boost coming out of this because it's so obvious now. Decentralized and transparent is the way to go. Those networks didn't skip a beat. All of the transactions were completed. And there are all kinds of metrics saying they're getting stronger now. It's very interesting to note that Sam Bankman-Fried, who has either committed gross negligence or outright fraud, he didn't like Bitcoin. He didn't like it. And why didn't he like it? It's decentralized, it's fully transparent, and he couldn't control it. He was trying to control the crypto world, master of the universe. And that was a recipe for failure. It's been most unfortunate because so many people have been hurt because of it. But I do think the big lesson, and even the newest SEC commissioner is saying, you know what, we really have to double down on this idea of decentralization and transparency and help to propagate this new world with the right kind of regulation. And it's not like they have to change regulations. As Brian Armstrong says at Coinbase, We don't need new regulations. We need clear regulations. And we certainly need more clarity from Gary Gensler at the SEC. And the other thing we need, I would submit, is we would have saved a lot of people from some of the catastrophe that FTX has presented them with something like a Bitcoin ETF, a regulated. Instead, a lot of people went offshore and then got carried away with it. So I think the SEC deserves some blame for what has gone on as well. Yes, we have never seen a market like this. This is worse than 08, 09. And I think many technicians basically took a chart of the tech and telecom bubble and the bust, and they said, okay, that's what's going to happen. That has happened to us and more. This is worse than the tech and telecom bust. The difference between the two periods is we've got into an irrational market in the late 90s. Investors were piling on technology stocks, actually trying to outcompete indexes and each other. So they ended up with 40% technology, but the technologies were not ready. We didn't get cloud until 06. We didn't get breakthroughs in deep learning until 2012. Not only were the technologies not ready, the costs were way too high. The technologies are ready, the costs are low enough. The seeds for what we're investing now were planted during the 20 years that ended in the tech and telecom bubble. That was irrational. And I think we're on the flip side of the bubble right now. I think what's going on right now is irrational. Many of our stocks are below where they were at the low point in 2020 when COVID hit. Some of them are back to 2017 levels. And a company like Teladoc, its revenues are up 14-fold since. Its gross margins are in the high 60s, we think moving into the 70s. And that compares to the NASDAQ's 43% gross margins. See what I mean about latent profitability? They have a lot more to spend to make this backbone of the high gross margins, high 60s, low 70s. This company, its ultimate profitability is going to be superior because we believe it will become the healthcare information backbone of the United States, if not elsewhere. So just think about that. High 60s, low 70s gross margins compared to the NASDAQ, 43%. And yet the stock is selling for, I believe it's around 2 times revenues, whereas the NASDAQ is selling at 3.25. This is as irrational on the downside as the upside was in the late 90s. And the reason this has happened is because of the tech and telecom bust, and even more so, the 08-09 meltdown. Investors are scared to veer much away from their benchmarks. When we get into a risk-off period, they are selling any stock that's not in their benchmark. Well, so they have been selling our stocks because they're not in the benchmarks. And it has reached an incredible level. But I also think if you ask where the risk is now in the market, I think it's in the benchmarks that everyone's crowded into because they're very backwards looking. And our portfolios are forward looking. Most people will not construct portfolios the way we do. They need their benchmarks. We need the best companies who are going to execute on the future of these 5 new platforms. And we believe those are in our portfolio. So if no other reason, given the down round we've been through, if for no other reason, we would be a great diversifier for those who are hewing to benchmarks where we think there's a lot of risk to the traditional world order because of innovation.